Okay, the last video we end at the first model called one period valuation model, right? And then we extend that one period dividend valuation model into any number of period, and we get this formula to calculate the expected price of the stock. The main assumption of the first model is the dividend from each period are the same. DT will be the same number, right? In reality, it probably not the case, not that case. So we come up with the next model is called Gordon growth model or dividend discount model. It simplifies the model that have been developed to make the calculation earlier, and they assume that the dividend has some growth. So dividend next year is actually dividend today plus times 1 plus G. G is the growth rate of the dividend that you expect. So you expect this company to grow in the future and the profit should grow, right? And the growth rate of the profit should be the same as growth rate of the dividend if you assume that the expenditure and the cost of production grow in the same percentage. So if you have D0 is most recent dividend paid from the latest report. What is their dividend that they just paid? The next period, you expect this amount to grow by G, right? So D0 times 1 plus G will be the dividend next period. Discount back by 1 plus KE. And then the 2 periods from now, and then so on, right? Until infinity. The previous equation can be simplified into this simple formula. There are some proof of the equation in your textbook if you are interested to see how they come up with this. But to simplify those equation, the previous equation, it become P0 or expected stock price equal to the dividend, the latest reported dividend times 1 plus G over KE. KE is the minimum rate of return that will induce you to put your money to invest, minus G. G is the growth rate of expected growth rate of the dividend. Or D1. D1 is the dividend that you expected to get the next period, right? It is equal to D0 times 1 plus G. This model is useful for finding the value of stock given a few assumptions. First assumption is dividends are assumed to grow, but at a constant rate equal to G forever. I know in reality it's not going to grow at the constant rate, right? The growth rate is assumed to be less than the required return on equity. So KE minus G has to be positive. Okay, so those are two assumptions that make this equation work. So what is it imply? The Gordon growth model imply that the fundamental price of the stock is simply the current dividend divided by rate of return on investment minus the dividend growth. The model tells us that the stock price should be high when dividends are high, when dividend growth is rapid, or when the rate of return on investment or interest rate is low. Now we know the theory behind the, the price of the stock calculation, or the model that try to explain how they come up with the price of the stock, right? Now we are going to put that into the market and to see how the market set the stock price. The price in the market is set by buyers' willingness to pay. Whoever willing to pay the highest price will get that stock, right? But the price is not necessarily the highest price that asset could fetch, but incrementally greater than what any other buyer is willing to pay. So the price of the stock could get to, well, we can calculate that it can get to, let's say, $60. But the buyer that exists in the market, the buyer that bid the maximum price will get that, and the maximum price that that buyer bid probably not gonna be at $60. It could be somewhere around $60, right? So that's how the market work, and whoever get more information about that asset can increase the value by reducing its risk. So whoever know more about the company performance, or, well, it's illegal to know some insider information, right? But so people try to find the update information from the news, and that's why people who put a lot of money in the stock market have to read the news all the time, because they want to gather as much information as possible in order to estimate the price that they should buy or sell, right? And when you're buying or selling the stock, the future cash flow have many unknowns. It's not only the dividend, right? It's other million variable that can have something with the stock price. The buyer who has the best information will discount them at the lower interest rate than will a buyer who is very uncertain about that. So whoever have a better set of information will know exact the risk, reduce the risk, that will reduce the the um, the interest rate that they want to get, the minimum interest rate. Let's take a look at the example. So let's say you are considering to purchase a stock that expected to pay $2 on dividend next year per stock. Market analysts expect the firm to grow 3% indefinitely forever. So your G will be 3, right? You are not certain about both dividends and the firm growth. You have no idea what is this company produce, how the performance was like 5 years ago or a year ago. You have no idea. So your uncertainty is a lot, right? To compensate the uncertainty for this risk, you require pretty high return. The risk premium for you has to be very high in order to compensate this uncertainty in your mind. So you said, I need at least 15% on the return on this investment. Another investor, Jennifer, has spoken with industry insider and feel more confident about this project cash flow. She know a little bit about the product that the company is producing, and she doesn't have that much uncertainty like you. So she require only 12% return because she has more information. her perceived risk is lower. That's why she requires less KE or rate of return in order to invest in this. But another person is actually dating the CEO of the company. He knows with more certainty what the future of the firm actually is. Almost everything in this firm he knows. So he has some confidence and some certainty in his mind. So he requires only 10% return. So from this different KE, what would happen to the willingness to pay in the stock, right? These are the value that each investor will give to the stock. So we use Gordon growth model. P0, we can go back to Gordon growth model. P0 equal to the dividend over KE minus G, right? You have KE equal to 15 minus 3 minus G. G is 3. It is what? 12. So dividend $2 over 12% is your stock price, right? You divide by something more. That's why your stock price is lower than other people. Jennifer KE is 12. $2 divided by 12 minus 3, that is 9%. So $2 divided by 0.09, you get 22.22. But who know exactly that the company would do, what company would do? He require only 10% in his mind. KE is 10 minus 3 is 7. 2 divided by 0.07, that is 28.57. So in this situation, your willingness to pay is the lowest. The investor with the lowest perceived risk is willing to pay the most for the stock. If there were no other trader but these three, the market price will be between 22 and 28.57, right? But has willingness to pay at this point, that means he will offer a little bit lower or somewhat lower than 28.57 in order to gain some surplus. And if you already held the stock, you would sell it to BUT because stock price in your mind is a lot lower than he was willing to pay. So you want to sell that if you have the stock in your hand already. So from this situation, the price that you are willing to pay depends on KE, right? The rate of return on investment that you want, or the discount rate. So whenever you have new information, your expectation change and KE change, then the price that you're willing to pay will change for that particular stock. New information can cause changes in expectation about level of future dividend or risk of those dividends. And market participants are constantly reviewing new information all the time. And then they revise their expectation all the time. That's why it moves every second. It is reasonable that stock price are constantly changing as well because of this Gordon growth model. Okay. The next video we are going to talk about why stocks are risky than other type of investment.